All right, everyone, welcome back. For those of you who don't know me, I'm Eric, a founding partner at Summit Metals. I've been navigating the waters of Wall Street for over 30 years now, and I've seen a lot of market cycles come and go. I've spent decades studying markets, analyzing trends, and talking to some of the most incredibly smart people on earth. And right now, frankly, the picture that's unfolding for gold and silver is one of the most compelling I've seen in a long time. Based on what I'm seeing and the insights from analysts I follow, our internal view here is definitely leaning positive for both metals going forward. Let's break it down into 7 sections. Please stay tuned for all. They're really good. The information provided is for educational purposes only and not financial advice. There's the disclaimer. Like, subscribe, and check the bell so you know when we post another video. We have some great content coming down the pipeline. All right, let's begin. Here's the outlook as I see it right now. Let's take a quick look back. So as of the filming, we're seeing gold trading around 3,337 an ounce, and silver, it's sitting near 36 an ounce. Now you might have noticed some pretty eye-catching moves recently. Gold, for instance, has been absolutely on fire, hitting 28 fresh records just over this year, 2025, and even punched through the 3,500 mark back in April. Silver hasn't been slouching either. It recently hit a 13-year high, breaking above 36.50. The ratio of gold to silver, the GSR, has actually dropped significantly, currently at 91.38, down from 105. It really does feel like silver is finally starting to play catch-up here. This recent strong performance is giving us a solid launch pad for what could be next. All right, now, what's driving things in the short term? Let's say the next 30 days. Let's zoom in for the next month. What are the big factors that can move the needle for gold and silver? 1, the Fed and interest rates. This is always a huge one. The Federal Reserve is currently saying they aren't planning any interest rate cuts until at least September. If they surprise us with a cut sooner, or even just sounded a little softer, what we call dovish in the market speak, that could literally ignite a rally in both metals. On the flip side, if they sound more aggressive or hawkish about keeping rates high, that could cool things down. As I've learned over 30 years, Fed talk is powerful. One comment can and will send prices swinging. Central bank buying. You might not hear about this on the evening news, but central banks around the world are big players in the gold market. While their buying slowed a little in April, their purchases were massive in the first quarter, somewhere around 244 tons significant. This consistent buying acts like a sturdy floor under the market, helping explain why when prices dip, they haven't fallen that far. Silver's industrial story is strong. Silver isn't just a precious metal, it's also used in tons of industrial applications. We've been seeing headlines about supply deficits, meaning there's less silver available than people need. And this is giving silver a legitimate push. Traders are watching key price levels like $36 to $38. And if these deficit stories keep coming out, silver could definitely test those levels quickly. Let's talk about global risk and tariffs. The world can be an uncertain place. Any unexpected tension, whether it's ongoing conflicts in the Middle East or new announcements about trade tariffs, they tend to make investors nervous. And when investors get nervous, they often look for safe places to put their money, which historically means gold. Now let's hit on market positioning just a minute. Looking at how big investors are positioned, like in futures markets, there are a lot of long positions, bets on prices going up. While things like COMEX inventories are high right now, the fact that big players like sovereign wealth funds and even retail investors in places like Asia are holding on to gold tightly means that any small dips are likely to be bought up quickly. You'd need something pretty big, like a sharp rise in real interest rates or a sudden scramble for dollars to cause a major sell-off. That I do not see happening anytime soon. So what's my short-term price look for the next 30 days? Combining these drivers, here's a way to think about potential prices over the next month. Remember, these are just educated scenarios based on information, not guarantees. Here's my base case. Let's call this about a 55% chance. If things stay pretty much as they are now, yield stable, central banks keep buying, and the silver deficit story continues, I'd expect gold to trade roughly between $33.50 and $34.50 an ounce. For silver, the base case has it moving between $37 and $39 an ounce. This aligns with most of the recent momentum we're seeing. Or more bullish scenario, let's say a 25% chance, is if the Fed surprises us by sounding more cautious, or if we see some global instability. Gold could really jump. In this case, I see a possibility of gold hitting 3,600 to 3,700. For silver, if gold rallies hard and the gold to silver ratio continues to drop, meaning silver is getting relatively more expensive compared to gold, we could see a momentum chase push silver up above 40, 41, even $43 an ounce. Now here's a less bullish scenario. In my opinion, about a 20% chance. Now markets don't just go straight up. If the Fed sounds very firm on rates or we see geopolitical tensions calm down unexpectedly, gold could see a dip, maybe down to 3,200, 3,250. For silver, if manufacturing data weakens or traders decide to take some profits, I could see a pullback to the 32 range or so. Even with the potential for a dip, my base and bullish scenarios for the short term show good potential upside, which fits our positive view. All right, now here's some key drivers for the medium term, let's say the next 6 months. There are some powerful ongoing trends that are very supportive of precious metals over this time frame. The possibility of Fed rate cuts is number one. If the economy slows, which it is, more signs are slowing, that is going to cause analysts like Goldman Sachs and others, as they have done, to advocate for a recession around 30 to 35%. Then the idea of the Fed cutting rates perhaps even 3 times becomes more likely. Lowering rates generally reduces the real yield you get on things like bonds, making non-yielding assets like gold and silver relatively more attractive. Continued central bank demand. This isn't a one-quarter phenomena. Data shows central banks added over 1,000 tons of gold in 2024, and surveys indicate they plan to keep buying. This sustained official buying is a fundamental shift and is expected to continue soaking up any supply that comes into the market. Geopolitical risks are becoming policy. If trade tariffs, which have been threats, start becoming established policy, this could bring back concerns about stagflation, where you have inflation, but the economy isn't growing much, stagnated. Historically, metals have performed very well in this kind of environment. Underlying market strength and the dollar's quality, as I mentioned earlier, there are strong hands holding gold, particularly in Asia. People globally are looking for alternatives to traditional paper currencies. As Keith Weiner points out, it's not just that gold is going up, it's that the dollar is going down. The massive debt levels and deficit spending in the U.S. create concerns about the long-term quality and purchasing power of the dollar, pushing people towards gold as a hard asset. This structural demand means pullbacks are likely to remain relatively shallow unless we see a really significant shift in real yields or a major dollar surge. In my view, it is far more likely that the dollar will continue to debase, go down. Now here's my medium-term price look the next 6 months. Let's look at some potential scenarios based on those drivers. Base case, around 55% chance. Assuming we get 1 or 2 quarter point cuts from the Fed and continued silver deficits, I see gold moving higher into the 35.50 to 37.50 range. For silver, that combination of deficits and increasing demand from EVs and solar could push prices to $41, even $44 an ounce. A more bullish scenario, around the 25% chance, is if we see multiple rate cuts, the economy hits a recession, or a major new global shock emerges, gold could literally accelerate, potentially reaching 3,900 to 4,100 an ounce. If gold gets above 3,800 and we see signs of a really tight physical silver market, silver could potentially spike $48, $52 an ounce. This aligns with the view that the fundamental trend for gold is higher, driven by the unsustainable debt situation. Now, a less bullish scenario, let's say about 20%, if fears of a significant economic slowdown fade and the dollar strengthens considerably, gold could see a larger correction, maybe down to 3,000, 3,150. For silver, a slowdown in manufacturing combined with higher interest rates could see it drop to 29, 31, somewhere in that range. Again, looking at the probabilities I'm assigning, the picture over the next 6 months leans heavily towards continuing strength for both gold and silver, supporting our positive bias. Number 6, so why the positive bias? Let's quickly recap why we're feeling positive about gold and silver. Gold is in a breakout phase. We see multiple new record highs this year, showing strong upward momentum. The market is clearly signaling something significant. Silver is gaining ground. After lagging for a while, silver is narrowing the price gap with gold, driven by its unique demand factors. Silver, as we know, has a powerful industrial story. The demand from the clean energy transition and technology like AI data centers is a significant growing factor specifically for silver. Now, based on my decades in the market, I can tell you one absolute truth. No bull market goes up in a straight line. We will likely see corrections along the way. Think about the massive gold bull market from the 70s. It had pullbacks of 10%, 20%, even 40%, dropped between 75 and 76. Garrett Goggin, a CFA I follow, makes this point well. These corrections can feel uncomfortable, but they can also be opportunities to potentially pick up quality assets at a better price. You have to be prepared for them and understand that the market doesn't always move logically in the short term. It is driven by collective emotions of participants. But the underlying long-term trend, in my view, remains firmly to the upside, especially given the global financial picture. We have spoken about dollar cost averaging many times on this channel. DCA with our Auto Invest program at Summit Metals is fantastic. I still firmly believe in this as a sound strategy for acquiring metals. Now, what are some important considerations and next steps before we finish up? Let's talk about a few crucial points. As someone who's been around the block, I've learned that forecasts are just that, forecasts. They are educated opinions based on available information, but the market can always surprise you. You can't control the market. You can only control how you choose to react to it. If the idea of a 10 or 20% pullback makes you nervous, make sure your position size is something you're comfortable with. Stay flexible. Stay informed. I really do now appreciate you tuning in. I hope this overview, based on my observations and the insights I've gathered over my career, helps you think about your gold and silver holdings. Don't forget to hit the subscribe button and notification bell so you don't miss our next market update. We'll see how things are shaping up then. Leave any comments or questions down below. I'd love to know where you guys think this market is heading. And again, thank you for watching and happy stacking.